Why would anyone do the infinite banking concepts? What is it? How does it work? What are the real reasons why the wealthy have used this system for a very, very long time? That's exactly what we're going to cover today on this episode. So let's dive in to showing you why and what the infinite banking concept is in your life. So imagine changing just one thing and then adding just one step to what you do with your money. Imagine if doing just those two things could change everything financially for you. Now, I know that's a bold statement. It makes you really think like, well, what if? What if I just change where my savings goes first, and then I add one step to how I use my money and how I make my money work for me? What if that literally could change not just your financial future, but the trajectory for your entire legacy's financial future? Your kids, your kids' kids, your kids' kids' kids. And shall I keep going? What if just those simple things could change all of that? I mean, you have to almost think about that and say, well, what if? And I know some of you aren't saying what if, you are saying I am, right? And that's the magic words, I am. I study a lot of Earl Nightingale and Napoleon Hill, and gosh, I've been reading a lot of stuff because I've been riding my bike again. So I get to read and listen to a lot of stuff when I'm riding my bike to the pool and hopefully soon to the lake. But in doing that, there's very common themes that have been happening throughout time, all the way from the Bible straight through to modern day talks. And those themes are all the same thing, just so you all know. And we're not going to get into those themes. We're going to stay focused today on changing one thing. And just so you all know, that is where your money goes first, your savings, to be specific, goes first. And we're going to talk about adding one step. And if we did both of those, what if you could become your own banker? And what if becoming your own banker meant you got to take back all of the banking functions in your life? And when I say all, I mean all. What if the next time you had to buy a car, you no longer had to go to a bank, a finance company, sit in the dealership and talk to their credit manager or finance manager and play the game? What if you sat down and you already had a plan? So your sitting down was simply to negotiate the price of the vehicle, not the payment, although you could negotiate the payment too, but just the price. And then when you were all done, you then took a loan from your banking system, bought the vehicle, made car payments, but you get to pick and choose how much the car payment is. And how I do it is I just say, what's the cheapest going rate or cheapest financial option I have in the public banking system or the public finance system, and I pay myself back the same thing. But you see, when I pay myself back, I lose no liquidity of my money. I lose no control of my money. I have full flexibility to change the payments, stop the payments, pause the payments. I am in control because thou with the gold makes the rules. And when you own your own banking system, you simply make the rules. This isn't hype. This isn't some, fly-by-night concept or whatever you want to call it, some guru talk. This is something that's been being done, not just for a little while, but for hundreds of years. I did a video, The History of IBC, and you can trace it all the way back to the Rockefellers, the Rothschilds, the Morgans, the Stanleys. You could arguably say all of them, in one way or the other, were in banking, and therefore realized that being your own bank, or realized that back then it wasn't called Be Your Own Bank or Infinite Banking. R. Nelson Nash, the late R. Nelson Nash, pioneered the infinite banking concept in the late 90s, early 2000s. But what they've always called it in the upper echelons is privatized banking systems, or just privatized banking. You've heard about this all the time, but when today, and the banks have gotten keen to this. So what do the banks do? They create their own private banking division, right? Very different than your own private banking system, but they have private banking. So it messes with our minds. So we're like, oh, well, private banking, isn't that just going in when I got lots of money, I get this private banker at my local branch office, and that private banker has more dum-dum suckers when I come in. Sometimes I get an umbrella when I'm a good boy or girl. Like that's your private banking relationship. See, that's not what we're talking about. We're talking about literally you taking back control of all of that. So in today's training, what I thought we would do is something very different. I thought we'd use visuals, and I thought what we would do is just walk through what does this actually look like. So the first step that we have to address is that one change. It's so simple. You all work or own a business or drive revenue or income from somewhere, right? You all make money. You wouldn't be on here. I know our average demographics. We are really good with technology, and we know the majority of what all of our clients are. And you know what? Most of our clients, they're actually doing very well financially, but they have a lot of questions, a lot of concerns. They don't like market volatility. They don't like the ups and downs. They don't like the risks. They just want something else, but they don't all know what they want. But they have the means, and they're ready for a change. And if they're in debt, they're ready to be out of debt, but they all have money. So what if, instead of taking this money and putting it into the bank and leaving it sit at the bank, where the bank then makes your money work for them, makes a spread off your money, actually makes 400 to 1,300% more than you do on your money that you worked for? What if you just changed where that money went? And not all of it. And listen, we'll use Dave Ramsey's baby steps. You can baby step this thing. You don't need to start big, small, and we're going to cover that. But what if you just changed where some of your savings went? Okay, what would be the benefit? Well, the benefit would be a higher guaranteed interest rate. You'd receive dividends every single year on your money. That interest and dividends would grow tax-free. And right now, by all the companies we work with, the giant mutually owned life insurance companies, which pay dividends, right now the dividend crediting rates are 5.9 to 6.6%. And did I mention that internal buildup of your cash value grows tax-free, and it's protected against judgments and liens in most states? Got a call from a friend of mine who lives in Florida, going through some rough stuff, going through a bankruptcy. First call, he said he was very concerned. He was doing his own banking system. He did set up one of these specially designed whole life policies, had a bunch of money in there, used it for real estate investing. Some deals went sideways and bad, which is very common in real estate investing land right now. And he's like, hey, listen, I'm really concerned. Am I going to lose all the money I put in this? I did a quick Google search. I said, creditor protection on life insurance in Florida. 100% creditor protected. So I said to him, hey man, all the money that you have in your cash value is protected against judgments and liens in your state. And that is the case with most states. Some states have limits and everything, but there's a level of protection on all states. So with that being said, why would you not at least entertain how this could work? We have a lot of clients, because we have thousands of clients. We have a lot of clients that literally they like the infinite banking, but they don't use this for the infinite banking. You know what they use it for? And this, I don't like this. It doesn't matter whether I like it or not. I don't do it this way. But they just put money in these specially designed whole life policies, and they just leave the money in the policy. And you know what their answer is when I say, hey, how come you got money in there? And I got a really good friend, my friend Brad. He's been a friend of mine for a long, long time. Every time I pull up his account, he's got all of his cash value in there. And I'm talking a lot. He's a wealthy man. A lot of money. I don't know if it's in the 7 figures, but it's definitely high 6 figures. And it just sits there. And I said to him, Brad, why don't you use this? Why don't you use this to do things? He's like, well, Chris, I don't have any debt. Anything that I want to buy, I just pay cash for. I have the cash, my income's really strong. So when I look at the returns I'm getting on this, it's far better than what I could get at a bank, any bank. So why is that a problem? Plus, he has not just 2 children. He's got 4 children total, between his 2 wives. And he's got a very successful business. And he's just like, the death benefit's just as important as the cash value, but the cash value grows. I don't have to pay any taxes on it. And I'm making 4 to 5% on my money. Like, what's wrong with that? And what could I say? Could I say, oh, there's a lot wrong with that. You could be making 10, 12%. I mean, listen, to each their own. For many of you listening to this right now, 5%, you might be like, oh, I'd be really happy with 5% on my money right now, guaranteed. Okay, well, we have lots of ways to do that. I mean, we have MYGAs, which are multi-year fixed annuities. We have those, and right now those are over 6%, guaranteed for a specified period of time. It's like no matter what people want in terms of guarantees, you can get it today. It's kind of like that buffet that has everything. The Las Vegas buffets that has everything. The market right now is prime for all of the folks out there, all of you, who are looking for that word guaranteed. And these specially designed whole life policies, they have guarantees. So I couldn't argue that. But here's the thing, back to Dave Ramsey, this isn't about Dave Ramsey anymore, but back to him, He knows whole life insurance, so I give him credit. He understands whole life. He understands the inner workings. What he says is not entirely wrong. Where he falls short is he thinks that all whole life is created equal, and it is not. We do not, I want to preface, we do not use traditional off-the-shelf whole life insurance for any of our policies that we use for the privatized banking system. Not at all. Every policy, every single policy is designed and engineered for that client. Now think about it this way, right? Let's just pick on a boring car, a Ford Focus. I always used to do this, and I'm going to bring it back. A Ford Focus, right? Is that a sexy car, anybody? Do any of you drive a Ford Focus? You're like, well, it's a practical car. I suppose if everything went to hell in a handbasket, I guess I would drive it, right? That's kind of how we looked at the Ford Focus. But you know what? There's this guy, he used to be with us. His name's Ken Block. He's passed, okay, died in a snowmobile accident. But he was probably the single greatest rally driver. And now that's up for debate, but he was phenomenal behind the wheel of a car. And for the longest time, he drove for Ford. And the car he drove was none other than a Ford Focus, that car we just talked about that is not sexy. But however, Ken Block's Ford Focus, I don't remember the exact, but it's probably somewhere around 600 horsepower. Very different than the Ford Focus you would probably get at about 180 horsepower at best. And that's probably the turboed option. His was like 600, meaning in his, he could be going sideways at 100 miles an hour in full control, drop a gear, hit the gas, and that sucker took off and was doing 140. Now that's a freaking car. So what was the difference between the Ford Focus we'd find at the Ford dealership and the one Ken Block drove? It's simple. Design and engineering. That is the only difference. Some bolt-on goodies, but lots of design and engineering, enabling Ken Block's Ford Focus, the rally version, to do things unimaginable with the regular Ford. But they are the same car, same chassis, same dimensions, almost all the same things. So again, back to building your own private banking system, you need an engine. A car doesn't drive without an engine. Whether it's electric or gas or diesel, whatever, it has to have a power plant. Your money needs a power plant. So what kind of power plant are you using? Oh, I've got a high yield savings account. Great. Oh, I've got just a checking account. I've got a money market account. Great, great, and great. What do you like about it? Well, I mean, my high yield savings is paying me 3% right now, but it used to be 4%. Great, so you're telling me that it could go down. All right, every year you get a 1099 for the interest, so you're actually not making whatever 3 or 4%. You're making less because you're paying tax on it. So we whittle this down. So basically, we just need a better power plant. But we need to design and engineer that power plant so that it is the most effective, so that it's like Ken Block's Ford Focus. So Craig, let's get into how we design these policies. This is step number 1, design and engineering, okay? So the first thing, when we look at this concept, when we look at a recap of this, I just want to hit on the fact that we are using giant mutually owned life insurance companies. Household names for most of you. If you follow U.S. swimming, you would definitely know the name One America. Yep, they're one of the giant mutually owned insurance companies we work with. How about Lafayette Life, which is a part of Western Southern, a massive, massive mutually owned conglomerate insurance company. And then you've probably heard of Mass Mutual, I'm sure. Maybe Guardian Life, you probably have heard of them. You may or may not have heard of Security Mutual. If you're in New York, you definitely probably have heard of them. So these are all household names. And then another one is Emeritus, which you probably have never heard of. But these are just household names. All of these companies have been around for well over 100 years. The oldest, I think, is 168, 69 years. And all of them, this is unique because they are mutually owned. And there's a very big difference between a mutually owned company and a publicly traded company. I want you to just think about that. Mutual means they're mutually aligned with you. There are no stockholders. There are no people pulling the shoestrings or, the little puppeteering, okay? Publicly owned companies, who owns a publicly owned company? The shareholders. Who makes the decisions? Well, indirectly, the board. Who picks the board? The shareholders. Okay? When there's excess money in a publicly traded company, who wants that money? The shareholders. How do they want that money? Dividends, capital gains, stock growth. Right. Mutually owned companies. You can't buy stock in a mutually owned company. It's mutually owned. Okay, so who benefits from a mutually owned company? Well, the policyholders. The policyholders inside of a mutually owned company are just like owners. Okay, they're treated the same because when there's excess money in surplus, who does the insurance company distribute that excess money to? It's policyholders. It's mutual policyholders. Of course, that's the dividend. And you know, all those companies that I mentioned in the well over 100 years of existence have never, ever, 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 not even once, not during the Great Recession, not during the Great Depression, they've never missed a dividend payment. Never. And here's a unique thing that you need to understand. When we talk about life insurance companies, they're very different than banks. I think a lot of people don't understand this, but a life insurance company, almost all insurance companies, they're regulated very differently. Now, let's talk about a traditional bank real quick. This is important for you to understand. A traditional bank, okay, when you deposit $10 in a traditional bank, that bank is required, okay, by regulators to keep roughly about $1 of that $10 in reserves. Okay, it's about 10%. You all probably know that. Some of you might look it up and AI it, and then you'll see, oh, no, Chris, it's like 11%. We're splitting hairs, but you're right. We'll call it 11%. We'll call it 10%. That's what they're required to hold in reserves. The rest of it is fiat money. Okay? So literally, think about the safety in that. $1 of every $10 is held in reserves. Oh, but let's make mention of what is considered reserve. So this is very well documented. You can go to FDIC. I think it's .us or FDIC, whatever. Just type that in and look up what banks use to hold their tier one capital, which their tier one capital is their most valuable capital stack, which is that 10%. And you will find that banks are allowed to use treasury bonds or treasury bills from the U.S. government, so debt issued by the U.S. government because it's backed by the full faith and credit of the United States of America. Okay, and they do. They use lots of treasury bonds and bills. But the other thing that you will find, and we've documented this very well, and you can look it up just the same as I do on FDIC, is BOLI, B-O-L-I. Now, if you look up BOLI or type it into any AI, what it will tell you that means is bank-owned life insurance, which is basically a derivative of whole life. It is just bank owned. It is owned by the bank. The bank then insures their vice presidents and their executives, gives them deferred compensation plans, employee benefits, and funds that all through these policies. So it's kind of funny. It just comes full circle. So who's the one guaranteeing or holding the reserves? Well, a large portion of it is these mutually owned life insurance companies. I've always known about this since I've been in the industry, almost 23 years. I always knew what BOLI was. I always admired that. I never knew why, though, but now I do. So when we talk about mutually owned insurance companies, the reason we use them is one, stability. The reason the wealthiest families use them is stability. They're safer than banks. And back to the reserve, a life insurance company, if you sign a contract, which is called a policy contract with a life insurance company, they promise you two things in a whole life contract, especially designed or regular. They promise you a guaranteed interest rate. They call it a non-forfeiture rate. All mutually owned life insurance companies have a non-forfeiture rate. Actually, I think all whole life contracts have that. So the insurance company guarantees you an interest rate, and that could be anywhere between 2 and as much as 3.75% by today's standards. Used to be 4, and then the IRS changed that. So they promise you and guarantee you that in a contract. And that guaranteed interest rate never changes. So if your insurance company that you go with pays you guaranteed 2% non-forfeiture rate, it will never, ever, ever be less than 2%. It can't be. It will never change. Your bank account could be 3% today, could be 0% tomorrow if the Fed changes rates. And just so you know, we got a new Fed chair who probably more than likely will drop rates. Second thing that the insurance company promises you is a death benefit. That is what you're buying. You're buying a death benefit to protect your family, to protect your children, to protect your legacy. But here's what most people don't realize. If your death benefit was $100,000, keeping this simple, okay? How much money does that insurance company need to have in their general account for reserves to guarantee you that $100,000? Does anyone know the answer? Thank you, FDIC.gov. I should have known that. How much do you think the insurance company needs to have in reserves? Some of you might be like, well, I don't know, probably the same as banks, 10%. But no, Matt is right, 100%. So if the insurance company guarantees you a death benefit of $100,000, that insurance company needs to have $100,000 in their general account, ready to pay out. Because you know what? kind of like Kyle Busch, 41-year-old superstar, legend, okay, healthy, dead in 4 days because of sepsis. Who knew? He didn't even know. He just thought he had a little sinus infection. You never know when you get to meet the maker. You never know when you get to go on to the real home, which is heaven. You never will know. And neither does the insurance company. So therefore, they have to have that money. But isn't that really the main focus? Don't you want to park your savings, your money, your prized asset in a place that actually has the money to give it back to you? Or do you want to just keep playing this game with banks? Because that's worked really well for a lot of people. Now, up to now, you're like, oh, who's lost money at a bank? No one in a long time. But that day will happen again, just like that day happened back in the bank run days. People do lose money in banks, but they don't lose money in life insurance companies. Look it up. AI, hey, listen, AI is the equalizer. Love it or hate it. There is everybody, no matter their level of knowledge, you could be the smartest person in the world or the dumbest person in the world. Doesn't matter. AI has got you covered, the levelizer. I went deep into this part right here because it is really important. The companies we use are built on guarantees. Therefore, they guarantee you things with utmost certainty that they can deliver on those guarantees. And they always have, 100+ years. Not only that, when you look at the infinite banking concepts, which is really what we're getting into, it's going to use just mutually owned life insurance companies. There's not one person who's an IBC practitioner, which we all are, that will use anything other than a mutually owned life insurance company. If they do, run the other way. Run. If anybody ever uses the word privatized banking, be your own bank, or infinite banking concepts, and then a product called IUL, run really fast. Like, Forrest Gump kind of run. Run, Forrest, run fast. Because we need a company that can provide you liquidity. We need a company that can provide you control, and that's exactly what we do. The goal is a steady and contractual growth. But then the second component to this, so I want to move on to the next one, is how we design and engineer these contracts. Because again, remember I said, like the Ford Focus, every one of these policies is designed and engineered to solve your problem. Now, everybody's problem is different, right? We got 117 people on here. That means we have 117 different problems. Maybe some similarity with some of them. Maybe my problem is I want to pay off debt. Oh, my problem is I want to pay off debt, but your debts aren't the same. So no one on here, that's the unique thing. No one on here has the same fingerprint, and no one on here has the same problem. So therefore, how could we say that there's one fit for all of you? There isn't. That's why there's not just one design. That's why when you hear somebody say, oh, 90-10 is the best. No, it's not. We could prove that mathematically 10 times from Sunday. Like, we could prove that absolutely. But when we design and engineer these policies, I will tell you one thing is pretty constant. We design them for high early cash value. We design them so you have access to your cash value immediately in the first 30 days. That is the equal. Okay, that is the one thing that is fixed. Now, is your design the same as the other person's? Absolutely not. And you know what? We designed software called the Vault. You can go to BYOBvault.com and you can test drive the Vault software, okay? Totally free for 7 days. See how it works. It's a software that literally allows us to mathematically prove everything with the infinite banking concept and privatized banking. There are no more secrets. There are no more guesses. There are no more concepts. It's literally mathematically proven now because of a software that was created by some really smart people. One is Craig Yenny, the smartest guy in the room. And he's also really good in the sheets from what I'm hearing. But anyway, nonetheless, a policy design has really 3 components. I'm only going to talk about 2 here. Number 1, the base premium. Okay. When you get a policy, whether it's a regular whole life policy or one of the specially designed ones, they will all have a base. I want you to think of a rocket ship, like an Elon Musk rocket, right? There's the fuselage, the main rocket where the astronauts sit, okay? And that thing blasts off, but there's also a bunch of rockets around the bottom that get it off the ground, the booster rockets, right? So the base is the fuselage of your rocket. It's super efficient. It's designed to go the long haul around the moon or to Mars. Elon Musk is going to colonize Mars. That's his one thing he set out to do. It's his worthy idea. That is the base. So all policies have a base. Now, a regular whole life that Dave Ramsey talks about all the time, that is 100% base, which means that it is not efficient in the first 2 to 3 years. When I say not efficient, and to Dave's credit, when he talks about whole life and he says, you put these stupid premiums into these whole life policies and you have no cash value in the first 2 or 3 years. He's right. If you had a policy that had 100% base. So are those bad policies? No, not at all. Matter of fact, I've done multiple videos of my old whole life policies that I started at New York Life, which are 100% base policies. Those suckers rock, but they sucked in the beginning. So when we design and engineer these, we put booster rockets on the base, and they're called paid up additions. Those booster rockets are designed and engineered to give you high early cash value. But you know what else they do? And Elon would respect this. The fuselage that Elon makes, okay, that is probably the most expensive part of his rocket. I'd have to believe it is, right? Then the booster rockets or the paid up additions, those are a lot less expensive and they're reusable, right? He launches them off, they come back down, lands them on a freaking barge and fixes them up and puts them back up into space again, delivering more Starlinks. Pretty cool. Paid up additions are kind of like that. The base is how we get compensated. Almost 100% of our compensation, to be specific, 98% if you want to get down to the brass tacks, of our commission when we do a policy is from base. So if we designed your policy with 20% of your premium deposit going to base and 80% going to the paid up additions, by what I just said, we literally just reduced our compensation by 80%. It's just math. If 80% goes to paid up additions and only 20% goes to base, and if base is what pays us our commission, then what we did. Now, that would be kind of a white lie, because we do get paid for the money, your premium deposits that go into the paid up additions, but we only get paid like 2%. So 2% versus 55% is a very big difference. Okay, so you can see when we design and engineer these policies, there is no magic. It's not some arithmetic thing or some secret hidden thing. There is no secret. We give and you get. When we design your policy, we give up our commission by designing it with more going to paid up additions. And what do you get? Whatever, you get that excess. You get that money immediately available in your cash value. So when we design, the structure of the design of the policy, okay, is what's going to give you the functions you want. Now, some of you might be like, hey, I got a bunch of money that I got in inheritance. How do I dump this money into the policy? Like, I just want to dump it all in. Great. That's an excess premium deposit, which would all go to base. And then from there, we would build, or I'm sorry, would all go to paid up additions. And then from there, we would build the base to facilitate those booster rockets by IRS standards. Because listen, the other cool part about this design and engineer is efficiency. You know what's not efficient? Taxes. Taxes. Think about taxes. How much do you pay in taxes? Is it 25% federal, or is it 30, or are you one of the lucky few that are at 39%? But whatever it is, you don't have to admit it, but that is not efficient. So when you have a bank account, you earn interest on your bank account or your money market, that interest is taxed. In short term, you tax normal income tax rates, which whatever your rate is, that's what it is. Or if it's capital gains, then that's still 15, maybe 20 some percent. That's not efficient. Think about that. If you didn't have to pay taxes on your growth, that would be like you making an extra 25, 30, 39%, maybe 15 if it's long term. That's not bad. And all you had to do is design it to be efficient by the IRS code. And guess what's one of the most efficient things you can put your money into by IRS standards? Look it up, Google it, AI it, life insurance. Some of the absolute best tax advantages out there are in life insurance within the tax code. So when you think about the wealthy, why do the wealthy use what we're talking about? Why do the wealthy do this? Duh, they want to be efficient. They want their money to grow. And to them, if they don't have to pay taxes at 40%, that's like them making an additional 40%. Forget about what the policy pays me, that 5.966%. Who cares about that? Dude, I didn't have to pay 40% on the gain. I didn't have to pay 15% capital gains, and wealthy are probably closer to 20. I didn't have to pay 20% on capital gains. That's like me getting 20% return. So the extra 4, 5, 6% I make on the policy, that's just on top. That's the icing on the top. Isn't that the truth? So really everything we do comes down to efficiency, efficiency, efficiency. But see, it gets so much better. Because all I've talked about now is the companies and the policies. I haven't talked about what we're going to do. So we talked about just the one change, where your money goes first. So once we get beyond that, now we get to the part where we actually get to perform the act of being your own banker. This is the part where you add one step. And that one step is you become the bank in your life. When you need to buy something, instead of going to their bank, you go to your bank. If you got 10 grand saved up in your policy and you need a new washer and dryer, and you're at the store, Orville's is our place, and they're like, oh, we got a great financing option on this. It's 6% interest. Your payment would only be $49.99 a month. Okay, so payment's $49.99 at 6%. That's what you're offering. Great. I'm going to go in and take a loan from my policy for 5 grand. I'm going to buy that washer and dryer. I'm going to pay $49.99 back to my banking system. I'm just going to keep that 6%. But here's the cool part. If you know how to do this, and the Vault software does all this automatically, but let's do the manual way because I want you all to understand this. Then you have to understand the most efficient way to do this. So right up on the screen, you see loans versus withdrawals. When you go to your bank account, if you're going to buy a washer and dryer, you would withdraw the 5 grand to buy the washer and dryer. Okay, and many people do that. I don't know how many people finance washer and dryers. I'm just giving you two sides of the coin. Okay, most people would just pay cash for the washer and dryer, but did that cost you anything? You know, I ask this to people all the time. When you pay cash for something, did that cost you anything? And people are like, nope, I got no payments. I didn't have to pay interest on anything. It didn't cost me anything, but it did. And this is the part that a lot of people don't realize. You gave up the earning potential on that 5 grand that you just paid to Orville's for that washer and dryer. You see, your money got withdrawn from your bank account. Your bank account was paying you something, 3, 4%. So you're not making 3 or 4% on that money. What is the future value of that 5 grand earning 3 or 4% 10, 15, 20 years from now? It's not going to be that much. Oh, I beg to differ. It would be a lot. Because compounding interest is one of the most powerful things in the financial world. Says Albert Einstein. Look it up. So when you think about how much it costs, well, it didn't have an inherent cost in terms of an interest rate that you had to pay, but you actually gave up earning whatever that money was earning. If that money was earning 3 or 4%, you gave up that 3 or 4% on that 5 grand for the rest of your life in exchange for a washer and dryer. Now, listen, I'm not discounting that clean clothes are a pretty nice luxury, but I'm just saying there's a better way. So when we talk about loans versus withdrawals, most people think withdrawals are better because they don't like the word loan. You've been taught to not like the word loan. And I get it. I don't like the word loan. I don't like taking loans. But when you are your own banker, loans are good. To a bank, when a bank makes a loan to you, that is good because that is an asset. A loan to a bank is an asset. A loan to you is a liability. Does everybody make sense? A deposit to a bank is a liability. So banks flip liabilities into assets, and they do that by taking your money, your deposits, and loaning that money out, then turning that loan into an asset which generates revenue in the form of a spread. I know I said that fast. Simple. If the bank pays you 3% on your savings that you leave in the bank, and then the bank makes a loan to somebody for 6%, with your money. They loan your money out. Just so you all know, like the bank is literally making your money go to work for them. And for that, they lend your money out at 6%. Who's making the 3%? The bank is, not you. When you're your own bank, loans are assets. So when you go into your policy and you take a policy loan, here's some important things to really notice and to really pay attention. And I have it written down here, but I'm just going to kind of give this to you straight. When you take a loan from your policy, we'll use that example. You got 10 grand in cash value. You're buying a washer and dryer. You take a $5,000 loan from your policy. You bought the washer and dryer. You didn't take a withdrawal. You took a loan. So whose money did you use? Well, you didn't use yours. That's the most important thing. Your 10 grand is still in the cash value, still earning guaranteed interest, still earning dividends in a tax-free environment, protected from judgments and liens, and is private. Oh, and by the way, it's self-completing too, because if you die tomorrow, guess what? There's a death benefit paid out tax-free to your beneficiaries that can be used to pay for that washer and dryer. Okay? Follow me? But see, here's the thing. When the insurance company makes a loan to you, what they're effectively doing is they're going into their general account, that reserve money that they have to pay for your death benefit, and they're taking 5 grand of your death benefit, and they're just giving it to you early. They're advancing you part of your death benefit from their general account. And your 10 grand that's in the account, 5 of your 10 acts as collateral for that loan against your death benefit. But because they're giving you part of your death benefit early, they've already promised and guaranteed to pay a death benefit the day you die. But you haven't died yet. So that money that they just advanced you effectively is a loan that never needs to be paid back. But that's even not right. It's a loan that doesn't need to get paid back until you die. And then it will be forced to be paid back because they will subtract whatever outstanding loan, $5,000 in this case, they'll subtract that from your death benefit. They will never ask you for the loan to be paid back. Now that, to some people, doesn't make any sense. They're like, wait, what? I don't have to pay the loan back? No, because they just gave you part of your death benefit. They collateralized it to protect them and all the other policyholders. So they backstopped it with your cash value. You can't take a loan of your death benefit for more than the cash value you have. So if you have 10 grand in cash value, you could not take a loan for more than 10 grand because you couldn't collateralize it. But here's what happened. Remember how I said if a bank pays you 3 and they charge 6, they make the spread. Let's flip that. Let's just do the math here. And this isn't going to be your math. The vault would give you your math, but I'm just going to kind of keep it super simple just for an example here. If you could borrow money from the insurance company, if you could borrow part of your death benefit at a rate of 5% simple interest, okay? That's about the going rate. Anywhere between, I think it's like 4.85 to 6.5% is one of the companies. So whatever the loan interest rate is, you can borrow at that interest rate. But if your policy was earning 6%, I'm just keeping the math simple, and you could borrow at 5, wouldn't you be making a spread? You would. But you see, remember I said you got to add one step, because I think everybody understands that part right there. But now we got leverage that we're going to put in there. We're going to add an element that very few people teach the right way, in my opinion. When you took that loan for $5,000, okay, you took it from your policy. $5,000 of your death benefit is now into the washer and dryer. You have 10 grand compounding uninterrupted, which is awesome. But now what we're going to do is we're going to treat our money the same way we would have treated Orville's finance company's money. So if Orville would have lent us the money to buy that washer and dryer at 6%, just like this, they made it sound so simple. $49.99 was going to be that monthly payment. I was contemplating just paying them $49.99 because I'm like, well, hell, I might as well just leave my $5,000 in the bank. I can just pay them $49.99. That seems like a good deal. So you keep that same mentality, except now you make a payment. You set up a bill pay. You just go in when you got the washer and dryer bought and paid for. You go home, you just go in and you set up a bill pay in your bank. Everybody knows how to do that. But in the name, okay, of who you're going to make this bill pay payable to, you write your name. Okay, whatever that is. We'll pick on Donna Bigner. Okay, Donna Bigner goes in the bill pay. $49.99 is the amount. Frequency, monthly. Boom, done. Now, every single month, Donna receives a check for $49.99. Donna takes that check for $49.99, deposits it in her bank, but then does one additional step. She sets up a transfer. We call it a loan repayment form, but I like to call it a recycle recapture method, where we're going to take that $49.99 out of the traditional bank where you deposited it, and we're just going to sweep it right up to the policy. That's right. Nothing changes. You lose nothing. You had $49.99 in the bank. When $49.99 goes back to your policy as a loan repayment, when you recycle and recapture, you have $49.99 that you could use the next day when your check clears. But here's what happened. That $49.99 is a reduction of the principal owed to the insurance company. You lost no liquidity. You lost no control of that money. There's no ties, there's no lockups, there's no reason you can't take that money. You could take it out the very next day, and you could take a withdrawal or a loan from that. Okay? But what you did is you just repaid $49.99 of your principal. And the insurance company, because it's simple interest, is charging you 5% on $5,000. But the first month, the insurance company is now charging you 5% on $4,949, am I doing this right? $51. Math is a little off, it's a penny, but you get the point, right? We'll just say $5,950. Is the interest more or less on $49.50 versus $5,000? It's less. Sorry, I'm getting tripped up on the way of saying that. You get it, right? But if you did that every single month, you put $50 toward that balance, you're driving the principal down, which means the interest calculated on that loan, your APR as they call it, is going to be less. So now after 1 year, let's just say you drove your APR from 5% where it was day one of the loan down to 4% month 12. You're now paying interest at a rate of 4%, but your money is still earning at a rate of 6%. Do you see what you just did? You just increased your spread. And you just did it by changing that one thing of where your money goes and adding that one step. You just became the bank. Now, you take that exact concept and you rinse and repeat that for everything in your life. You pay all your debts off doing that exact same thing, which is my favorite thing to talk about. We do that with the vault now, with the debt blaster. It's wicked. But we do that with cars. When I do marketing campaigns for my company, if I don't have the money, I just borrow the money from my policy and I repay my policy back with interest. I'm going to show it. So any of you that join us for the next couple webinars, I'm going to show you one where I'm going to bring my real policies into the mix. I'm going to go into the vault and show you all my real stuff. And I'm going to show you how I use this, because I use it too much to really just segregate it down to just one thing. I mean, I talk cars a lot, but we use it for a lot of things. If you go into my business, I lend my business all sorts of money. I lend all my businesses all sorts of money because I don't want to borrow from the bank. Shauna knows this. We very rarely ever borrow money from the bank. Literally, the bank's got to give us like 7 figures or more for me to even entertain that. And the only reason I would even entertain that is, well, hell, why not have access to $1 million, you know, in case the market falls and I can buy things at a discount. Like, that's an extra $1 million of access. But I'm always going to use my banking system. If I've got money in my private banking system, that's what I'm using. I expire other private lenders for real estate stuff. I do all sorts of cool stuff. And you can do the same thing. But this is why you take loans. So right down there on the slide, you see it says capitalization matters. You are building liquidity, reserves, and financial capacity to control your future banking system. Here's the beauty. There will never be a day in this environment, in your banking system, where you'll have less money than you did the day before. Never a day. But let's move on to the next part, okay? This is the reality versus assumptions. So when we really look at this, and you know, I clearly threw in a kitty cat. Shauna did that for me. People make assumptions. They think it sounds too good to be true. They think that they're not ready to do this. We hear this all the time. Oh, I'd love to do that infinite banking, but I'm just not ready. I'm not there yet. Okay. And that's because you're making assumptions. You're making assumptions that to be your own bank, to the ideal banker, if you will, has to be high income. And if you're low income or medium income or whatever else, not high income, you're thinking you're not ideal. But the reality is very different. The reality is wealth is built on behaviors, not on your actual balances. Stephen always loved when I said this. I always said, you know, it's not about your actual resources. It's about how resourceful you can be. Now, I'm just going to pause real quick, because when you think about behavior, behavior really comes down to mindset and discipline. All of you have a certain set of skills, a certain mindset you've developed over the years. And the bad part about that is, however old you are, I'm 48, I've got 48 years of false belief when it comes to money. Everything I've been told about money up to the point where I learned how to be my own bank was really kind of just to benefit others. Really, it really was. So the mindset I was developed around money, part of it was scarcity mindset, because I grew up in a lower income family. My mom was always like, we're not heating the outside, you know, if you kept the door open, or if the lights were left on in a room, well, you know, I can't remember what her analogy was. There was an analogy for everything that I did. So we pretty much lived in darkness. We made sure that the heat, I don't remember what my mom kept the heat at, but it was low, man. It was freezing. I had to wear heavy clothes. It's just because she just didn't want to afford to pay for that. And I'm sure many of you are like that, but that develops a scarcity mindset. I still struggle with this. I do. My wife catches me all the time. Oh, there you go. There's that scarcity mindset again. And I'm like, damn it. You can't get rid of it. It's discipline that overcomes that scarcity mindset. It's discipline that overcomes the false beliefs of what money actually does for us and how money actually works. And there's also intentionality. You have to believe. Remember I said earlier, I am. You have to start saying, I am. And you have to develop systems and tracking and processes and procedures around this. But you don't have to do that. We already did that for you with the vault. And then you really, really need to change your relationship with money. You know, anybody that says to me, oh, money's the root of all evil. No, it's not. No, it's not. Money's just the tool. What you do with the tool, well, there you could use it for evil. But money in and of itself is just a means of exchange. It's just a tool. So you got to change your relationship with money. Also, someone was asking about Canadian. Does this work for people in Canada? 100%. We do a ton of work in Canada. Matter of fact, I'm surprised we don't talk about it more. We have partners, IBC practitioners up in Canada that facilitate that. Your rules are a little different from a taxation standpoint, but the designs and everything else all remain the same. So if you're in Canada, everything we've talked about up to this very point, exactly the same, with the exception of your taxes, your tax advantages on the policies work a little bit differently, not as good as here in the States. But yeah, that's just another way for me to make it a little bit sweeter. Stephen just put the ticket there. And also too, I'd be remiss not to kind of mention, as we kind of been going through this, there's a lot of people that already think like bankers. Even if you're not being your own bank already, I bet you there's a lot of tendencies of what many of you are already doing that make you a banker. And it's funny, just the other day, one of our mentors, Carson, was on the phone with somebody, and he was talking to this gentleman. The guy owned a trucking company, might even be on today. I'm not going to use names. But one of the unique things is in this conversation, we found out that this gentleman had been segregating his money. So at banks, he had multiple bank accounts. One bank account was for his general living expenses. Another bank account was for something else. Another bank account was for vacations. So he was already creating different pots of money, splitting his income. So he got his check. He was smart enough and had that mindset and intentionality to then take his paycheck and split the paycheck up intentionally based on what he wanted in the future. He knew how much money he needed for his bills. So part of his paycheck went in for the bills. Part of his paycheck went into this other bucket, which could be for future investments or just investments today. And then his last amount went into this other bucket, which would have been for like vacations. And I can't remember the specifics, but by that person doing that, what we automatically knew is this person is going to be perfect at being in their own bank. Because being your own bank is so much like that. It's so much about intentionality. It's so much just about your patterns of what you do and how you use money. And if you're already doing that, actually, matter of fact, how many of you do some form of that in your life now, where you kind of segregate buckets of money for various things? And listen, I bet you all of you do, because you probably all have a retirement account. So you're putting part of your money away into a retirement account so that someday you can draw income out of that and you don't have to live off the government. So I bet you a lot of you do. I know Shauna does it, but Shauna does a bunch of that into policy. She's got multiple policies now. And somebody just asked, how do they contact us? And I think that's what they were asking. So one of the other things too that we've done is we've gotten away from giving you just a link, although you can click a link and book a call with us. But what we did is we know that most people, when they're ready to do something, when they want to talk to somebody about what this would look like for them, they just want to call somebody and they want to talk to a human being. How many of you love talking to AI? Any of you Tesla owners? You call in to Tesla for anything, you get to talk to AI, and guess what? Even that sophisticated company, AI can't solve your damn problem, ever. I don't believe in any of that. So we have a phone number that all of you can use, and guess what? With one click, you just tell us what division you want. You want to talk to somebody about being your own bank, you want to talk to somebody about MIGAs or annuities, you want to talk to somebody about private money club or PMC wealth. Those are your four options. You click the one, you get a human being answering the phone. And we always have mentors standing by who are well-trained. You're not going to get sent off to some other country to talk to somebody that doesn't speak the language. You are talking to our mentors trained by us, and all of them, if it's the BYOB, are IBC practitioners. So that phone number, if any of you are interested, is 866-329-BYOB. And we'll put it right up on the chat. And for any of you that are watching this from YouTube, it'll be right on the screen, 866-329-BYOB. So we'll put that up there, but you can just give us a call. Now, for any of you on this webinar today, you could just go in and you could send us a private message to host. Okay, you just go into the participants and you just go to host and just give us your phone number. And we'll reach out to you with a text message and say, hey, when would you like to chat? We make this super simple. Because we already know many of you have been around the campfire for a while. You've been looking at this, you've been pondering this. Our average client has probably been around our campfire for 6 months or longer. So if this is your very first time, congratulations for being here, but you're probably at that point where you're just kind of doing some due diligence. You're just feeling it out. You're like, I heard about it. I didn't really know if I'd like it, but let me kind of see what it is. And then some of you are like, I'm ready to go. I'm ready to talk to somebody. You might not be ready to go, but you're ready to talk to somebody to see what would this look like for you. Because, like it says right there, some people already think like bankers. They just do. That's just what they do. They want to minimize their liabilities. They want to turn liabilities into assets. They want to avoid inflation. Okay, so how do you avoid inflation? Well, your money earns at a higher rate than inflation, which is not a hard thing to do, especially right now. Now, when it was 9%, a little bit harder, but that was a very short little blip of time. Right now, inflation, what, 3.8? No problem. Your policy's cash value growth will exceed inflation. And because it's tax-free, it's even more efficient than that. So these are the different things. But as we kind of move through this, when we think about banker ready versus policy ready, there is a difference. There are people who are banker ready. Now let's just talk about people that are banker ready. Okay, banker ready is someone who thinks long term. If you're going to be your own bank, you have to have a long-term vision because listen, banks don't make money overnight. Banks make money a little bit every single month on that spread. You have to think like that. So you have to think long-term. This is a marathon, okay? This is something that your life will improve gradually over your entire lifetime. It will get better and better and better and better. That's how compounding interest works, but that's also how being your own banker works. You have to understand opportunity cost. Okay, opportunity cost is what we talked earlier. If you take a withdrawal from your bank account, you lost opportunity costs, okay, because your money can't earn for you. You have to understand that. That's a long-term thinking thing, but that's banker ready. Most of you understand that. You have to be willing to build systems. Remember I said you're going to change one thing. That's easy, but then you have to add one step. And for some of you, that's super easy because you're already doing it. You know, you're segregating, you're doing all these things. That's easy. But for others, that's just different. It's not the same. It's not hard. It's just different. So you have to be willing to build those systems. And again, we've kind of got the easy button, like Staples, you know, the easy button with the vault, because you can just use the vault and it does it all for you. You just got to know what direction you want to go. You know, it's like getting in your car. If you're going to drive somewhere, you got to have an address that you're going to get to use GPS. Well, it's the same thing in the vault. You have to have an address. You have to know what your destination is going to be so you can tell the system, here's what I want. And then the system will help you obtain that. And then you have to, again, I'm going to use that word again, you have to be intentional with your money. All those things would signify you as being banker ready. That is very different than someone that is policy ready. Somebody that's policy ready is ready to change that one thing. And that person is someone who is consistently saving money. You see, it's very difficult for us to build a policy for somebody that is not saving money. Somebody that is living paycheck to paycheck. I'm not saying we can't help them. The vault, the debt blaster, the book, all those things can help somebody that's living paycheck to paycheck, trying to get out of debt. We got a solution for you. It may not be a policy though. So somebody that's policy ready is somebody that is already consistently saving money. Somebody that understands liquidity margin. You may not even understand what that means, but you will. When you're policy ready, we will help you understand liquidity margin. That is the margin of your money that is liquid. That is an important factor. You also must understand capitalization ability. You have to want to continue to capitalize your banking system. I've never ever heard of any bank that has succeeded and that is still around that has not always been in capitalization mode. Banks are always raising more money, always trying to find new deposits. When you create your own banking system, the one thing you will do is continuously try to increase your capacity, increase your capitalization. That is the name of the game. The more money in your banking system, the more control and the ability for you to take back the banking functions you will have. It is a long-term thinking kind of game. And not only that, health quality. You have to be relatively healthy, not super healthy. You don't have to be able to run marathons or Ironmans. You just got to be healthy. You know, if you just got diagnosed with cancer, it's probably not going to make you policy ready, but it certainly means you're banker ready. And then we have to do what banks do. We have to find someone else you have an insurable interest on, a business partner, a spouse, a child, that you then could use their life, their health, as the insured, and you become the owner. Okay? So these are just some of the things between banker ready and policy ready. So there's another thing we're going to be doing here in a second when I bring Craig in, just right after this. It's going to be super fun because it's going to get down to actual use cases, and I'm really excited about it. But before we do that, we got to go into funding your bank. I mentioned capitalization a bunch. Okay, so when you capitalize your policy, what you're doing is you're putting money into your policy through what's called premium deposits. You're making deposits of premiums into the insurance company. No different than you making deposits into a bank, making deposits into a 401k, making deposits into a brokerage account. You are basically capitalizing your system, your banking system. You can do this monthly. quarterly, semi-annually, annually. You can do it all up front. You can do it, gradually over time. I've done most of my policy designs gradually over time just because that's how my cash flow worked. I never really had big chunks of money because back in the day, I would take those big chunks and I'd buy real estate or I did private lending. So how I've built my banking system might be very different than how you will. I've done it slowly and gradually with monthly deposits. That's how I've done it. And we can give you an example, but well, easy way is somebody like I'll just use one of mine. $570 is one of my policies. I did that every single month. Now I could have just taken $6,000 and just dumped it in all at once. See the difference? One is $500 a month. One is 6,000 all at once. 6,000 all at once is going to grow a little bit faster because all that money is compounding from day one. Where $500 a month is 1/12 of that 6,000 every month. So it's just a slower build, but it gets you to the same destination. So don't not do this because you're like, oh, I don't have the money saved up to do it. Great. Neither did I. I did it month after month after month. And guess what? It freaking worked. And I think all of you are here because I do this and everybody on my team does this. You will never ever talk to somebody on my team on that 866-329-BYOB number that is not using the be your own bank methods in their own life. They are all performing the infinite banking concept. And if they weren't, they wouldn't be doing calls, period. So with all these things, you have to think about your routine. You have to think about what you're doing. And for some of you, there's going to be some shifts. Some of you maybe are putting a large amount into your 401k, but yet you might want to be paying debt off and you're struggling to do that. Well, let's back off the 401k and redirect some of those 401k contributions. Some of you, your savings habits, maybe you're dumping as much as you can towards your mortgage, trying to pay your mortgage off. I got news for you. There's a more efficient way. I promise you, a much more efficient way. And I'm not saying like your efforts have not gone unnoticed. And I'm just saying there's a better way. Let us show you. And then any other predictable financial systems you can think of. The goal is to build the system, and the consistency and persistency matters more than perfection or you thinking you need to fit this little box. Now, what I want to do now is I want to turn this over to Craig. And actually Craig and Steven, and I want to talk about your path. And I want them to talk about their path, okay? So we're going to talk about Craig's path. We're going to talk then about how his path might be very similar to some of yours. So Craig, let me turn this over to you and you can kind of talk a little bit about this section.
Yeah, and just in case I disappear, I'm still working my way through a cold, so just bear with me. But one of the things I want to talk about, Chris, is, as you know, I do a lot of strategy calls, as our other money mentors do. And the important thing for everyone to know is we're going to meet you where you are. So we've talked a lot about the different strategies and how we use the system. But at the end of the day, everybody's in a different place. And I like the way you said that, Chris, where everybody has a different thumbprint. Yes, everyone has a different thumbprint, fingerprint, whatever it's going to be. And everybody is in a unique situation where cash flow is different, their goals are different. Maybe I want to pay off debt. Maybe I'm looking to buy a major purchase. I have a car purchase coming up in, say, 2 years I want to get ready for. Or you might be at the point where you don't have any debt, you don't really have anything to buy, but you want to build legacy and you also want to build emergency and opportunity funds that you can go invest and make more money with. So at the end of the day, everybody is in a different place. That's the main thing I want to start with. So what does it look like if you were to, call that 800 number that Stephen put up, or you were to book a call? What we're going to do is have a conversation with you. We're going to learn where are you, and sometimes the first step is just learning, and maybe you don't know for sure, like where's your cash flow going? And I've got some tools that I send out to people to say, hey, what are your debts? What are your expenses? What's your income look like? What are your assets? Because as Chris mentioned prior to this, we may want to have conversations about, although we're not financial advisors, I can't tell you, what to do with your 401k and your investments, but here's what I did years ago when I started this process. This was my decision, which was I don't want to fund my 401k anymore. Now, I know some people want to fund up to the match, some people don't want to fund it, but I quit funding my 401k and I ran all my money into the policy. And I've built multiple policies over time by doing that because I wanted to have control of that money during my working years, during my life. I wanted to be able to leverage it to go buy things and pay it back. I wanted to be able to use it for emergency funds. So that was my decision. That's how I got started 18 years ago, is I just quit funding this thing and I started putting my money over here. That may not be the path you want to do. You might be in debt. You might be saying, well, I don't have any cash flow. Every dollar is going into debts. So here's an example. I've met with people that are saying, "Hey, I don't have any cash flow." And when we look at it, we look at all the debts and how much money is going to each debt. Well, I'm paying $500 extra a month to this debt because I want to get rid of it. Right there is just a matter of reorganizing how that cash flow works. Could we potentially take that $500 of overpayment, run it through a policy, then take the loan and throw it at the debt? Now, what are we doing? We're capturing that money in our system. And what is that? Every month I put that $500 into the infinite banking system or my own system. What's happening? Well, it's compounding. It's growing for the rest of my life. And so I'm not losing the opportunity to lose to earn the money on that particular $500 that I put in every month. Those are just some things that we talk about on our strategy calls. Now, I'll take even a step back further. And Chris, I'm sure you've had this. Stephen, you've had this. Our money mentors run into this. Sometimes we're talking about your cash flow, and don't feel bad if you're asked about, what are your expenses, what's your income, and you don't know. If that's your answer, that's okay. Like I said, we're going to meet you where you are. What I do in my own life is I use Quicken, and I've used that for many, many years. So I could, if you wanted to know, I could probably tell you how much I spent on groceries back in 2016. I mean, it sounds kind of funny, but I've got all those numbers. Why is that important? We want to know our numbers. We want to know where those leaks are in our cash flow. We want to know where our money's going. And if you have money coming in and money going out and you don't know where it's going out, you don't know how much is going out to each thing, that's where you could use a tool like a Quicken. You could use a tool like a Rocket Money. It's a free tool that you can use. So I may have you do some work to start figuring out where your money's going, what's coming in, what's going out. Is there something we could, maybe look at and say, hey, I'm using Uber Eats way too much, and if I brought my lunch to work, maybe I'd save $200-300 a month. These are the things that we want to talk about, right? So once we understand that cash flow, then we can start making decisions about if we're in a debt situation, what's the best way to flow that money in a debt situation and help you get out of debt. Now, even if we get to that point, you might go, every dollar's going to debt. I have groceries because I have to eat. I have gas to get to my job, and everything else is just I'm just meeting my minimal needs of paying the debts. We can still put a plan together. We can still start acting like a banker today. We may not be using the ideal tool, but we can start to put a plan together, say, hey, in 6 months, 9 months, maybe it's going to be in a year, we're freeing up cash flow. Now we can simply shift that cash flow into this better system. So all the habits that we're going to build, we may not be able to implement infinite banking right now today, but what if we could in 6 months? We start building those habits and we start running that money through a better system. So with all of that said, why I wanted to kind of share some of the experiences of some of the outcomes of the calls we had. We've had some people that show up that don't know their numbers, so we help them learn their numbers. We have some people showing up that don't have any extra cash flow, and we can reorganize how their money's flowing and then get some of that money into a better system. We have some people show up and say, "Hey, I don't have any debt. I don't have to buy. I'm not buying anything in the future. How does this work for me? How does this work for me?" And so all of those things have answers. Um, so anyway, I just want to take a quick pause there. So Chris, do we have any questions that we want to jump into?
Yeah, could you hit Donna's question? Donna
Let's
said,
see
just
here.
paid off some personal real estate, now trying to pay off 2 vehicles and a little credit card debt. I have some of the credit card and 0% balance transfers until next year. Would it be better to pay off what is subject to interest and recapture that debt while paying the minimum on the 0% interest debt while paying the minimum on, oh, sorry, paying the minimum 0% interest debt into the commercial banking system while I pay off the policy loan or recycle the payment each month and continue to eliminate the debt that is on a 0% that's a great question, capture even those minimum payments. This is where the vault really shines.
Yeah, and that's where I would want to put all of that into the vault. And Don, if you're not working with one of our money mentors, I think you are because you mentioned you have a policy coming soon, which is awesome. Congratulations. But what we want to do is run that scenario into the vault. Now, I can tell you there are cases that I've looked at where somebody had a 0% credit card. Maybe they're in that introductory period. Does it make sense to take a policy loan at 5 or 6% and put that into to paying that off? There's always a short-term answer and a long-term answer to almost everything that we do. Short term, can I move faster by just maybe not paying off that 0% card and doing something else with it, and just keep doing that minimum payment and putting that money into and then deal with it down the road? So what I like to do in the vault and the why I like to run those numbers is I want to see what's the short-term benefit, what's the long-term benefit of doing plan A versus plan B. And we may find out that long term, it might be better to pay those cards off, free that cash up so we can do something else with it.
Well
So
said.
it's really the answer is it depends, and I'd want to run the numbers because there's other stuff that you have going on. So if I could free up some cash so we can get into maybe an opportunity that you want to get into and we could build more wealth, that may offset and make a good reason why we want to get rid of those 0% cards. We can just free that up and get it out of our life.
Love it.
So lots of different ways we can go with that one.
Craig, just to pivot a little bit, I cannot help but bring this up. Being somebody that did a lot of real estate and paying attention to contractors and really good work with contractors, can everybody look at the screen real quick? Look at the right-hand side. See that tile?
Yep.
Look at how perfect those grout lines are. Look at that. That is exceptional. Anyway, I just thought I would pattern interrupt what we were doing and go on to the next thing. I think the next section I really want to hit on, and Craig and Stephen, I really want you guys to be there. I just had to do that pattern interrupt is act as if. This has been something I've done in my life that has been incredibly valuable. And it's simple. There are things you want to do in your life. So act as if those things are already happening. And let's just think, like some of you, I have to believe, with how many people we have on here, well over 100 people, some of you are like, I want to be my own bank. But then you're going to add, but. No problem. Like I said, our average client's been around the campfire for 6 months. So if this is day one, week one, month one, you're probably still, but. Okay. You want to, but. So here's the challenge. I love challenges. Earl Nightingale has his 30-day challenge with the strangest secret in the world. I literally have told hundreds, maybe even thousands of people to take that challenge, and many of you have. And anybody that I ever work with, I always say, listen, the very first thing you're going to do is a 30-day challenge. So I'm going to challenge all of you to act as if. And we're going to do a really fun, super simple challenge. Okay. How many of you are interested in taking on a challenge? Okay. And it's right on the screen. It's very simple. You're going to start now. Okay. That's the beauty. And what you're going to do is either, and I'll give you to the end of this week to start this challenge, because anytime after the end of this week, you will forget. So you have till Friday. You have to go online or go into your bank. And all I want you to do is I want you to open a separate bank account. I don't care if it's a checking or savings account. So if you have one checking account at XYZ Bank, I want you to open a second one. Okay, got it? You could do this online. You don't even need to leave your computer or your phone. You can set up an online bank, a bank account online very simply. And if any of you want to use Bank CMG, they're great too. So that's step number one of the challenge. Step number two, in your mind, I just want you to think of the amount you would want to put into your private banking system. It can be any amount. $250 a month, $500 a month. Some of you might be like, well, hell, I think I want to do $1,000 a month. Great, whatever your number is, doesn't matter. And what I want you to do is I want you to set up an automatic transfer or a bill pay. Listen, I like bill pays. I'm old fashioned. Every time when I do an investment, like with Eckert or anything, I ask them to mail me a check. I just like holding a tangible check. There's some dopamine hit you get. I can't explain it. I just like it. So for some of you, the automatic transfer is fine. And for others, if you really want to act as if, what I'd like you to do is set up a bill pay. Now, this is going to sound silly because let's say you got an account at Bank of America and you opened a second account at Bank of America. You know darn well you can just set up an automatic transfer. But what I want you to do is do a bill pay. It costs you nothing. And I want you to set it up for that dollar amount. That dollar amount we just talked about. What would you want to capitalize your banking system at? 250, 500, 1,000? You pick the number. And then what I want you to do is every month when that check shows up in your mailbox, you open the check, you're like, sweet, I paid myself a check. I want you to then take that check and I want you to deposit it into that new account you just created. That's it. That's it. And I want you to do this for 90 days. 90 days. So for some of you, maybe you'll set up those checks weekly, others bi-weekly, others monthly. Obviously no more than monthly because 90 days, that's 3 months. I just want you to start acting as if you are your own banker. And this is the challenge for today. Very simple, but it does require you to actually do something and take action. And that's the thing. So many people go through life, on webinars and books and podcasts and everything, gathering knowledge. Think of school. We go through all the years of going to school and college, gathering knowledge, learning new things. How much of what you learned you actually apply in real world life? Very little. Very little. Knowledge without application is worthless. So what I'm challenging you to do over 90 days is actually, you've got the knowledge, you now have the challenge, now you have to actually act on it. And you have to consistently and persistently do it for 30 days, for 90 days. Because you know what'll happen? After you do this for 90 days, you'll keep doing it. Because you will start to build a money habit. You will start to be intentional. This is what acting as if looks like. And listen, that's how simple this is. There's no pressure here. It doesn't cost you a darn thing. Maybe a couple minutes, maybe a half hour. I don't know how long it takes you to go to your bank. If you go to the bank, it's going to take you a little longer because you got to sit down. But you know what? Maybe that act of doing that is what you need. This is intentionality, folks. Okay? This is how you get where you want to be. Just showing up is not enough. It never has been, and it never will be. It's showing up and then taking action. I do a speech all over the country, and I always open up with this part where I stand on a chair and I jump off the chair, and it's mimicking when I was a pro snowboarder, my first professional contest. I had this monster jump I had to hit. I was scared to death. I literally almost didn't do it, but then I leaped. This is the leap. You need to leap in life. And everybody will fight you on that. Mark my words, the closest people to you will fight you. We hear this every day. Oh, my husband or my wife doesn't want to do this. They don't believe in this. They don't think this works. Okay? Then let them stop you from, getting where you want to be in life. See, a lot of times people will stop you at what you're doing. Okay? They will tell you all the reasons why they think you shouldn't do something, even though they don't know anything. It's like Will Rogers said, the biggest problem isn't what people don't know, it's what they think they know. They think they know what's best for you. So then they try to protect you and shield you from these things. But here's the thing. What I have found, and what many of you have found, is when you actually do something, and you do it with intentionality, and you succeed at it, the same people that told you not to do that very thing, the same people that said that's a dumb idea, the same people that said that's a scam, that's not going to work, you're going to lose it all, are the ones that come back and be like, can you show me how to do it? Isn't that the damn truth? Like, it's just crazy. But that's how it works. So stop letting other people control your leap. Just leap and then come back and watch. Watch those naysayers. They will come to you later. I don't know how much later, but they will come back saying, that actually worked, huh? Yeah, it worked really well. You like the Porsche? Yeah, that worked really, really well. Yeah, I get all the money back for that damn thing. Crazy how that works, isn't it? Wow, you think you could show me how to do it? Sure thing. Here's a 90-minute video. Start there. Oh, well, why do I have to watch a 90-minute video? Because I did. Because that's what I had to do. And that's how I got where I'm at. So that's what you have to do. That's your challenge. For the next 90 days, open a bank account. Transfer the amount. Act as if you are starting your own private banking system. Act as if you are capitalizing your private banking system. That's how you do it. And once you do that, after that, After 90 days. I already told you what's going to happen, but let's just put it right on the screen just so you can kind of see this, take a picture of this. This is the important stuff that we're getting into today. Notice how we're not trying to sell you anything. I gave you the path. I gave you the 800 number. We'll give you the link. We gave you the blueprint stuff to buy the ticket and the free hat. Okay, but notice we don't sell anything. We solve problems. And that's what I'm trying to do. I'm trying to get you to be intentional. I'm trying to get you to solve your problem. We will help, but sometimes it's just best to learn and do it yourself to prove that it works. Well, a lot of people start a policy, shit you not, excuse my language, but they start a policy and then like within the 30 days, they take a loan. And then they get super freaking excited when the check shows up. And they literally will come online on a webinar or call us up and be like, hey, you're never going to believe this. Like that thing you taught me to do, that policy, I took a loan and the money showed up in my account. I'm like, yeah, really? That's awesome. What did you do with it? Oh, nothing. I just wanted to make sure that that you guys weren't full of crap. I wanted to make sure it worked. Oh, yeah, it worked, didn't it? Yep, money's in my account. Great. Now what are you going to do? Oh, I'm just going to send it back to my policy. I don't have the use for the money, so I'm just going to put it back. I just want to prove it worked. Literally, like we get that. That sounds silly to some of you. Some of you are like, no way that really happens. I swear that happened. And it happened more than once. It's wild. So after 90 days, your money movement that we just talked about for whatever dollar amount it is will feel normal. It won't feel like a stretch. It won't feel like it's crimping your lifestyle. It won't feel like, oh my gosh, I'm not going to have enough money to pay my bills. You just all of a sudden it just becomes normal. And there's always money to lean back on because now you got another reserve of money over here in that second account. Like if you need money, you just have it there. Great. So let's begin the next challenge after that, which if you join us next week and the week after, we'll try to put a challenge in each week to go further. Okay. But 90 days is this challenge. Your savings already exists. You're just repositioning it. You're just being intentional with acting and doing something to not to prove, but to actually get used to the habit of moving money. Because money in motion is how you get wealthy. Money just sitting stagnant, regardless of compound interest, is never going to make you wealthy. Nobody has ever saved their way to wealth. Mark my words. Their money worked for them, and they found ways to do that. And this is just the beginning. And consistency is the proven differentiator. Okay? You have to be persistent and consistent. So 90 days, that's just a test. It's just a challenge. Your emotion, okay, because there's emotion. You're emotional about money. Your emotional resistance to this will diminish. It will go away because it will become a habit. It will become normal. And that is the shift that you need. Craig, you want to talk a little bit about this, the infrastructure?
Yeah, so the infrastructure, what's going to be really easy is once you've built that habit Chris just talked about, and one thing I just want to reiterate too, Chris, is when that deposit's going into that separate account, they're getting into that motion and the money moving over there. We know that washers break, dryers break, mine just broke. You're going to need some money, car things break down, your car breaks down, you need to get repairs. No problem. Go over to that system, pull out the money you need for that specific thing you have to repair, the car, the washing machine, or dryer. But there's one more step. If you do that, come up with a payment plan to go back into that savings account. So now you're going to have your regular savings going over to that account, and then you're going to have your repayment. Maybe it's $25, maybe it's 50. But really all we're doing is we're building that habit because that's all we're really doing. Once you've built that habit, guess what we're going to do? We're going to change out the infrastructure that you're using. We're going to put a specially designed whole life policy in place. You're going to do the same thing. Money's going to be going in there every month. You need money for a car repair, you pull it out, you create your own repayment back in. It's the exact same thing. We're just switching out the tool for the infrastructure, if you will, for something that's more efficient. All those things Chris talked about. You get the tax-free growth. You get the uninterrupted compounding. You get the protections from judgments, liens, and predators and creditors. So all those things we've talked about, we're simply building a better infrastructure for you to have control of your money going forward. So that's really what phase two is going to be. Once you've done this 90-day challenge, give us a call. We'll help you switch out the infrastructure.
And listen, I started with this and I'm going to wrap with this because we're getting to the top of the time that we have with you today. Infinite banking, being your own banker, it's a process. it's not a product. The product just makes it more efficient. It's truly a process. And we've kind of walked through that process. And there's an average timeline on how this thing works. After your 90 days, or some of you, maybe you're booking a call already, or you're already calling the 800 number, which, I know Brian is sitting by waiting, if you guys need it. But this webinar and all of our other webinars, we do 6 of these every single week. Okay, they'll become your community, your sounding board. There'll be people that think and are doing the same things as you. And sometimes that's really important. That's why they have like AA meetings, right? Because what do they say? Flocks of a feather. What is that saying, Craig?
Birds of a feather.
Birds of a feather flock together. That's right. And this will become that community for you. But when your first year or 6 months or however long it is, you're gonna learn about the concept, about the process. You're gonna learn about the capitalization, which is that 90-day challenge I gave all of you. And you're gonna learn about access and how this will solve your problems, whether it's paying off debt, getting money back for all the cars you buy, drive, and own, and whatever it is you desire. You'll learn about all of that. Then after that, it's gonna be about growing liquidity. It's gonna be about capitalizing. It's gonna be about building confidence, building your personal system, because everybody's system is going to be built differently. Some of you will use the vault, some of you will not. But no matter what, every one of you that allow us to help you on your journey, we have a whole team that basically helps you fulfill on what you're doing, helps you get off the ground, keeps you accountable, keeps walking you through, and we're there for you whenever you need us. The vault just simplifies that like a GPS would in your car. In the long term, you're going to expand. It becomes about capacity. You've heard me maybe mention, or maybe you haven't if you're here for the first time, but I don't just have one policy. I have, I think, 15 or 16 of them. I don't even know. I should go count. But I didn't want 15 or 16 policies. This isn't a race. Okay, if I could do it all with one, I would have, but you can't because of the IRS code and the tax-free nature or tax advantages of these policies. You capitalize your banking system. It's the same reason why a traditional bank has multiple branch offices. You will have multiple branch offices, which are multiple policies, because over time, over the long haul, you are taking back all that control, which means your family, your life just has more money coming at it because you're not giving money away. You're not leaking. It's all just coming back to the source. You are the source. Your banking system is the source. So that just increases your capacity. As your capacity grows, you outgrow that first policy. Then you outgrow that second policy. Those policies are still working and functioning, but they're functioning up to the amount of capitalization you were at that time. And as you exceed that, you add on. The system consistently grows as you as a person grows. So you will grow. And because you are growing, because you are evolving, your system will grow and evolve. And I think that's the one thing. And I think Shauna always says it. It's not about being perfect. I know I mentioned that grout line. This road is not perfect. This road bobs and weaves through the forest. It's not about being perfect. It's about actually doing something. It's starting. It's leaping. That's what matters here. So if you are ready, like I said earlier, to build your own banking system, you got several different things. You could spend the next 3 days with us or get the recordings for those three days for the BYOB blueprint. We'll put up that link in the chat again. And for any of you that are watching the YouTube, we'll put it right in the description, the link for that if you wanted to get the recordings. Obviously, by the time this goes up, because this recording will go up Saturday, we'll be done with the event. So you would just be able to get the recordings. But if you want to book a call, I'm going to put it up there again, and it's 866-329-BYOB. Whoops, actually, I can't put it up there. I didn't save it. Stephen, can you put that up there, the phone number? And, any of you watching from YouTube, it'll be right on the screen. You can just call us anytime you want and just tell us what you want, and we will deliver. And here's the cool thing. We believe in the Ritz-Carlton model. It's called the new gold standard. So everything we do is about solving a problem for our clients. That's all we do. We don't sell anything. We just solve a problem. And when we solve a problem, something unique happens. People ask to do business with us. It's a very empowering thing, and it's something I wish I knew my entire life, but it took a long time to learn. When you solve somebody's problem, they ask you to do business with them. It's kind of strange, right? Like if we're the ones that you would think are trying to sell, we're not. We're just trying to solve a problem. And when we can demonstrate and show you that we and this system can solve your problem, you will ask us to do just that. With that being said, thanks for joining us. We'll see you on the next one. Hey, one other thing too, I want to give you something. I got this book that I wrote, The Private Money Guide. In the description, there's going to be a link on how you can get a free copy of this. Just cover the shipping and handling or grab the ebook. See you next time.